This is chapter 17, where we're going to talk about job order cost systems and overhead allocations. Bechtel is an example of a company that does big projects. They construct power plants, renewable energy facilities, highways, bridges, airports, and each of these are unique and different, and they require a system to track those costs. Sometimes the costs are reimbursed, or it's a cost plus, where you take to the government and say, here are my costs, and they write you up how much it should be. But certainly for profitability, and especially to assign values to inventory on the balance sheet, that's at cost. They need to be able to track that. And they do that using a job order costing system. So cost accounting systems are methods used to track resources consumed, track costs, right? And management uses this information to see how much resources have been consumed and to reward and evaluate employee and manager performance. And we're going to track this information to support our inventories on the balance sheet, cost of goods sold, and other operating costs, especially operating expenses, that are going to show up on both the balance sheet and the income statement. These are going to be used by both manufacturing and service companies. So a manufacturer might say, okay, what's the cost to produce one iPhone? Or providing a service might be, I am going to audit your company and I need to track the cost of that. Particularly so I know if I'm making a profit or not. Do I need to raise prices? Do I need to pick different customers? How much is it costing us? And also, which is part of this, is to help provide managers with the information they need to both plan and figure out, how much to bid on the next audit job or the next bridge you build, and also to control costs. So we use job order costing, and job order costing simply says we are going to track the costs of materials, direct labor, and overhead for each individual job. Okay. And so it can be as detailed or as small of a job or as big of a job as needed. But, Bechtel, which was our initial example, says we are building a bridge in Fayetteville, Arkansas. How much is that going to cost? Let's track those costs by the bridge in Fayetteville, Arkansas. And so they're going to do that. If a job contains multiple units of a product, then they're going to take the total cost of the job and divide by the number of units manufactured, just to get an idea of the per unit cost there. So who uses job order costing? Well, anyone that has a unique job. So construction, shipbuilding, defense, print shops, automotive repair. In each of these cases, certainly law and accounting firms, if you're going to do an audit or something, each of these have very unique, notice it's custom furniture makers. So these are each unique, and that usually says we need to use a job order costing system. Okay, as part of this job order costing system, we need to track direct materials and direct labor. And generally that's easier to do because I know when I used to work in an accounting firm, I'd say, who did I work for during this time? What job am I going to charge? But it's much harder to allocate overhead. And so, first of all, we note that why not apply overhead costs evenly to all products? Well, because each of these products and services are different, right? If you look through these are all very different. One construction job might be build a whole power plant or a nuclear power station, and the other one might be, building a ship, and they're just going to be so different. So it doesn't make sense to charge them all the same amount. We also don't know the overhead costs, the total, until the end of the year. And so what we have to do is estimate on an ongoing basis, on a daily basis, what an expected amount of overhead costs should be allocated to each particular job. So to do so, we have something called an overhead application rate. So what we do is we say, what is the estimated overhead we're going to have? And then we're going to establish an application rate based on some driver or some activity base. It might be things like direct labor hours. We say, hey, more direct labor, that's a way to consistently and systematically allocate overhead, or machine hours, or some other method. And so we're then going to assign based on that activity base. Okay. And so how do we do that? Well, we're going to establish a rate where we're going to have, and notice both of these are estimates, which means it might be off, but we were not going to know the total till the end of the period. So we're going to estimate overhead costs, and we're going to estimate how many units are in the activity base, like how many direct labor hours are we going to have during the year. And so if we're going to allocate overhead based on direct labor hours, we need to have an estimate of both of those. So here's the example. CompuLine Corporation is a company that creates individualized software programs for other companies, and they have estimated the cost will be $360,000, and that the total direct labor hours is going to be 30,000. We also have an activity base that might make sense for software programs, and that's how many lines of code have been written. And we think that our company CompuLine is going to produce 1 million. And so we have some choices. We're going to either take 360,000 and allocate it on the basis of direct labor hours, or on the basis of lines of code. And we're going to kind of see which one works the best there. So if we use direct labor hours, it would be 360,000 of cost divided by 30,000 hours, or $12 overhead per direct labor hour. But if we use, and instead of, so then if software requires 200 direct labor hours, we're going to take the 200, multiply by 12, and assign 2,400 to that job. And we haven't accumulated our costs. This is still estimates, but we are trying to assign it as we go because we need to make decisions before the end of the year happens. That's illustration 1. Illustration 2 says, hey, instead of using direct labor hours, let's use number of lines of code. And we decide 360,000 divided by 1 million lines of code will be 36 cents per line of code. So if 1,000 lines of code are required to produce particular software, we should assign or multiply 1,000 times 36 per line and assign 360. So if this were the same software job, notice in this one we charge 360 and this one we charge 2,400. And so you can see that difference there and how that might show. So assume you're a manager of the engineering group at CompuLine and you create the software code. Also assume that CompuLine is using lines of code. One of the engineers in your group has just approached you suggesting that if line of code used for software patches could be reduced 10% in general, the company could reduce overhead costs by 36,000. How would you respond? Well, it's not just the reducing the number of lines of code used, it's actually reducing the amount of overhead. And so if you can reduce the amount of overhead, then you could assign less, right? And so that's the key, right? Is did you actually, you might have used less lines of code, but if we're still charging 360,000 in overhead, it's got to be allocated some way. And so we've got to figure that out. So what drives overhead costs? Sometimes we call them cost drivers. An activity base must be a causal factor in the incurrence of overhead costs. An increase in the number of activity-based units, for example, direct labor hours worked, must cause a proportional increase in the actual overhead costs incurred. So we are on the search. We are looking for what causes more or less overhead. What is associated? What is the relation where an increase in direct labor hours, for example, is proportionally to the increase in actual overhead costs. So we have to pick the correct cost driver. In our last example, we said, hey, lines of code or direct labor hours, but we might use machine hours, computer time, setup time, or for example, if our factory is highly automated, direct labor might not make sense anymore to use. And so we've got to use something to apply that overhead. We may also not just use one base. So again, our example from a minute or so back, where we were looking at lines of code versus direct labor hours, maybe we assign both because different activities might consume different amounts of resources, overhead. So each allocation rate is based on a given cost driver for that specific department or task or procedure or product type. And we're going to go through an example of what this looks like. But let's talk for a minute about a job cost sheet. Now, these are typically going to be done by computer, but we like to show what a job cost sheet looks like, because a job cost sheet will tell us what the cost of the finished goods are and help us compute the unit costs of production. So we're able to do that. So here is the completed job sheet. And so we can see what that looks like for a French dining table made by oak and glass furniture. And so it looks like there's 100 units manufactured, and it could be either milling and carving or finishing. So we see how many direct materials. We see what the direct labor is. And we also see the application of manufacturing overhead. So we can see by looking at this that it is not allocated on a direct labor hour basis. It is allocated on a direct labor cost, which is proportional, but take the 14,000, multiply by 1.5 or 150%, and you get your 21,000. And so you could apply that based on hours or based on costs, but it's going to be 150% of the direct labor costs to allocate the manufacturing supply. So you can see kind of two departments and how the manufacturing was applied. Okay. And so this says, hey, we applied 30,000 worth, the 21 plus the 9, or the 30,000 to these jobs. So this is for one job. This next slide is for multiple jobs. The last one was job, let's see, 831. And says this is accumulating for 830, 831, and 832. So you can see the portions here that are going from direct labor, from manufacturing overhead, from raw materials inventory, and all of this is going over to work in process inventory. Those that are completed, looks like jobs 830 and 831 are completed, and they go to finished goods inventory. And then the amount that is sold goes here to cost of goods sold. So you can kind of see how these roll. You can also see the subsidiary ledger here. So work in process inventory is the control account, but here are the three jobs, 830, 831, and 832. These are the ones completed, went to the finished goods ledger, which all supports this. So you can see, for example, this 90 and this 75 add up to the 165, right? And you can see how that looks. And this one is the 120 plus the 30 plus the 50 that have been sold for the 200. And so you can see how that looks. And so this is detailing the journal entries that are used here. So at month end, all the materials used during the month are totaled. The following summary entry is made in the accounts. So the amount that went from materials to work in process, you can see that. Here's the entry from direct labor to work in process inventory for the direct labor. And here's the accounting for the overhead costs that have occurred. And you can see that that is 150%. That's our application rate, 150% of the direct labor cost, which is 150% of 60,000 is 90,000. So you can see how that works. Okay. Because the predetermined overhead application rate is based on estimates, both the costs as well as the activities, right? The direct labor hours or direct labor costs, as well as the total manufacturing overhead, we're always going to be off. It's never going to be exact. So it's either going to be underapplied or it's going to be overapplied. And so either we didn't apply enough or we applied too much. And so we're going to close that balance out at the end of the year. We're going to close that to the cost of goods sold. And so those charges will show up in cost of goods sold. Okay, so assume you're a treasurer for ABI, a manufacturer of industrial lasers. Among your many responsibilities is supervising preparation of the company's tax returns. The assistant treasurer has pointed out to you that the controller is allocating a significantly large and material amount of underapplied overhead from last period from work in process, finished goods, and cost of goods sold. The assistant suggests that assigning the entire amount of underapplied overhead to cost of goods sold would have advantageous tax consequences. And the question is, hey, it has been underapplied through all of these, so to just charge it out to cost of goods sold, is that appropriate or not? Should we allocate it and apply it consistently to each of the accounts, or just cost of goods sold? And so if the only reason to do so is to reduce taxes, but it is deceptive, we've got to be really careful with that. So now going back on the scenario we've been talking about, Job 830, Job 831, as they're completed, they're going to be transferred from work in process to finished goods inventory. And so this just comes right off those T accounts from earlier. But we can see we did 90,000 to make 600 of them for $150, or 75,000 to make 100 French court dining tables. Job 831 will be $750 a piece. And so finally we sell. We're selling 40 of the French court dining tables, and we sell them for $48,000, but the cost was $750 a piece, right? And that's just from this right here, this unit cost for 831. And so that goes both the receivable and the sales. This could be cash, but it looks like it's sold on account. So debit accounts receivable, credit sales. And then that's the revenue side of it. That's at market value, what we sold it for. But here, cost of goods sold and finished goods inventory are our costs that are transferred from finished goods to cost of goods sold. Now we're going to kind of shift a little bit and talk about activity-based costing. And we're going to talk about all of the cost driving activities that might occur. This simply says instead of one overhead rate or even two, we may choose to have multiple overhead rates to allocate and the cost of those activities to the usage of these resources. So let's see what this looks like. Well, here's an example of Ford, and they were able to use ABC techniques to cut costs, and that ended up changing the procedure of how they paid their payables to their suppliers. But how ABC works is we take overhead costs and we divide them into a number of activity cost pools. Each cost pool represents either a type of overhead activity, or such as building maintenance, materials procurement, factory utilities, and machinery repairs. And overhead costs in each of these pools are applied to the production separately. Because each of these costs, the drivers for each of them might be different. It's going to be different for building maintenance than it is for factoring utilities. So what we're going to do is put them together. And so the advantage is it takes it closer. It takes the overhead costs to their appropriate drivers. Because these activities are so different from each other, we've got to find appropriate cost drivers for each. Okay, so here's the example. Assume that master file makes 2 lines of file cabinets, metal file cabinets, and wooden file cabinets. In a typical year, the company produces and sells approximately 42,000 metal cabinets and 9,000 wooden cabinets. Total manufacturing overhead at this level of production is expected to average about 249,600. And what they're using now is direct labor hours. They're just saying, we're going to allocate this on direct labor hours. Metal cabinets uses 2, wooden cabinets uses 8. Okay, and so we're going to apply that at that rate. Okay, so we've decided the rate is $1.60 per direct labor hour. That's consistent with this, $1.60. We have 249,900 is our estimated level of overhead, and 156,000 is our estimated number of direct labor hours. And so using a single base, we're going to apply this based on how many direct labor hours we use. So the metal cabinets, we said we're using 2. That's back from this slide, 2. But wooden cabinets uses 8. And so it gets applied even more to the wooden cabinets. So you can see the cost card for these two: direct materials, direct labor, and manufacturing overhead. So here's the cost. So that is what is used. Okay. The problem is that the price of wooden cabinets averages $10 per unit more than comparable products. And metal cabinets are sold for $3 less. And it could all be because of the way that overhead is allocated. Okay, and so we may need to look for another rate. So what we can do is take, for example, maintenance department and utilities costs, and we could see what they are. And when maintenance goes, 3 of the 5 employees are about 60% of the time. So 60% of 180,000 goes to the repair cost pool. 40% of this 180,000 goes up to the setup cost pool. 35% of the 69,600, it goes to the heating cost pool. And 65% of this 69,600 goes to the machinery cost pool. So here are our activity cost pools. This is how it's been accumulated. Now, let's go and see what this means. Establish the percentage of total maintenance department cost to be assigned to each activity pool. So 3 and 2, so 60-40, that's here, right? 60%, 40%. Here it made sense to allocate it on the basis of kilowatt hours. So we're going to say 60% of the kilowatt hours, 40% of the kilowatt hours, and we're going to go ahead and show that. Now we're going to do the same thing, but now for the utility costs. Okay, and so for the utility costs, we decided the appropriate base is kilowatt hours. And so we're going to allocate that on the basis of 35% for heating, 65% for machinery, and we're going to take those utility costs and allocate them according to those proportions. Okay, so we see that. And now we're going to take that, and we have each of these, we have the activity pool cost. So let's just go back 108.72, and here's 108 and 72, and then 24,360 and 45,240. That's here. And then we're going to allocate them on the basis of cost drivers. So the repair cost pool looks like it's allocated on the basis of work orders. The setup cost pool is allocated on the basis of production runs. So we're allocating between metal and wood. Metal and wood, and we're taking that to, so here's 86.4, here's 54, here's 21.6, here's 18, and we're going to continue to do this. Now the heating cost pool we're doing by square feet, and the machinery cost pool, we decided to make sense to do that by machine hours. And so we can kind of see what that looks like as we're allocated between the metal and the wood and seeing what that looks like. Okay, so this is now just that detail of how it was allocated into 86.4 and 21.6. So here's 86.4 and the 21.6. All right, so there's repair costs, here's setup and its allocation, here's heating and its allocation, and here's machinery and its allocation. And in total, we're going to have the manufacturing overhead cost per unit of 481 and 531. So notice how different that is from what we did when we had a single base. For metal cabinets, hey, we think using activity base costing, our best estimate was 481. But if we just use only direct labor hours, it would be 320, difference of $1.61. But notice how different this is for wooden. 531, okay, where's that 531? It comes from here. But when we started, we allocated based on 8 direct labor hours at $1.60 or $12.80. You can see that big difference. And what were we finding? We were finding that there were too many costs associated with wooden cabinets, probably because we assigned too much overhead to the wooden cabinets. So instead of 531, we were assigning 1280. So we can see what that looks like. And so here are essentially our cost cards here. Manufacturing overhead for metal was 481. Wooden cabinets is 531. And we can see that what it would be, the sales price, if it were from the ABC system or the single activity system. So you can see that, see what that looks like and what a difference it makes.